Welcome back to Investing Talk Podcast.
It is great to be back, and today we are tackling a giant.
We absolutely are. But first, let's set the scene properly because context is everything here.
Right.
It is Tuesday, January 2026. The markets are doing their usual chaotic dance, and right in the center of it all is a company that, it effectively changed how the entire planet consumes entertainment.
We are talking about Netflix.
Exactly.
And the timing couldn't be more critical. Netflix has just reported their Q4 2025 earnings. And looking at the data, the headline numbers are, quite frankly, massive.
Massive.
We're talking about a subscriber base that has swollen to 325 million people.
Which is basically the population of a large country. It's a staggering reach.
It is. But here is the twist, and this is why we're talking about them today. Despite those massive numbers, the stock actually slid in after-hours trading.
Right, so you've got the central tension.
You do. On one hand, you have these incredible fundamentals. On the other, the stock is trading roughly 40% off its highs.
And that's the big question we're going to try and answer today. Is this a screaming buy-the-dip opportunity on a tech giant that's, on sale? Or is the looming shadow of that massive, $83 billion acquisition of Warner Bros. Discovery turning this into a debt trap?
That is the multi-billion-dollar question. Is it value or is it a value trap?
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out.
It really does.
Okay, let's strip this down. Let's look at the engine under the hood. Take us through the numbers they just dropped.
So let's look at the double beat for Q4 2025. Revenue came in at $12.05 billion.
Okay.
That's up 18% year over year, which beat the estimates.
And hold on, let's pause there. 18% growth. For a company this mature, that is actually pretty wild.
It's impressive.
Usually when companies get this big, the law of large numbers kicks in and growth slows to a crawl.
They are defying that typical maturity curve.
Yeah.
And on the bottom line, adjusted EPS earnings per share was 56 cents.
And that was up.
That's up 30% year over year. So they're becoming significantly more profitable as they grow.
Okay, so they made more money than expected and they kept more of it. That tells me they aren't just selling more, they're keeping more of every dollar they make.
Exactly. That is the definition of operating leverage. Their costs are growing slower than their revenue.
But the stock dropped. So what are they telling us about the future that has people spooked? Because usually a double beat pops the stock.
The guidance is actually quite solid, which makes the market reaction interesting.
Really?
For Q1 2026, they're guiding to about $12.16 billion in revenue. And for the full year of 2026, they were projecting revenue between $50.7 billion and $51.7 billion.
$50 billion.
It's a staggering number. But the real story, the thing that should make your ears perk up, is where that growth is coming from.
The ad tier.
It's the advertising engine.
Right. I remember when they first announced that, everyone was skeptical. Oh, no one wants ads on Netflix. It ruins the user experience.
And everyone was wrong. In 2025, ad revenue hit $1.5 billion. That is up 2.5 times year over year.
Wow.
But here is the kicker for 2026. They are projecting that to double again to approximately $3 billion.
So they are building a multi-billion-dollar advertising business basically overnight.
Pretty much.
Just for context for you listening, building a $3 billion ad business usually takes a decade. They're doing it in about 24 months.
It's unprecedented speed. It's no longer just a side hustle. It's a core growth engine. And importantly, ad revenue tends to have very high margins.
Okay, so let's unpack this from a skeptic's point of view. Revenue is great. Ads are booming. But I look at the spending and I get a little nervous. We know they spend a fortune on content. How are the margins holding up?
That's a fair concern, especially in Hollywood where budgets can spiral. But the data shows that operating leverage, their operating margins are expanding to 31.5% for 2026.
Meaning for every dollar they bring in, they're keeping about 31.5 cents as operating profit.
Precisely. And that includes the drag from potential M&A activity.
So they're getting more efficient.
More efficient at turning revenue into profit, even while spending on shows like Adolescence or K-pop Demon Hunters.
K-pop Demon Hunters. I still can't believe that's a real hit, but the numbers don't lie.
It's a massive hit.
It really shows their algorithm can find an audience for anything.
It does. And that brings us to the balance sheet. You mentioned spending. They are sitting on $9.3 billion in cash.
Okay. Against how much debt?
about $14.5 billion in gross debt.
Okay, so net debt isn't terrible, but it's there.
It is manageable, especially when you look at the cash flow. Free cash flow is projected to be around $9 billion for 2025.
So they are printing cash.
They are.
Yeah.
That's cash they can use for buybacks. They just repurchased $2.1 billion worth of shares, or to reinvest in more content.
Let's talk about the moat, because for a while the narrative was Disney is coming, Amazon is coming. Does Netflix still have that defensive wall?
I think the wall is higher than ever. It really comes down to network effects. When you have 325 million paid subscribers, you have data that no one else has.
You know what people want.
You know exactly what people want to watch before they do, and they are using that to drive retention.
Right.
Absolutely. Think about the live events. The NFL Christmas 2025 game was huge for them. They are proving they can do live sports, they can do massive global IP launches.
And they're closing that monetization gap with their own ad tech.
Exactly. And I saw they are rolling out interactive ads in Q2 of 2026.
Yes, that's the next phase, moving from just showing you a commercial to having you interact with it.
Which advertisers will pay a premium for.
Huge premium for that kind of engagement. Okay, so fundamentally the machine is humming, but the stock price tells a different story. Let's pivot to the charts for a second, because this is where it gets confusing for the average investor.
It is a complex picture and painful if you bought recently.
We have this psychological pullback. The earnings were a beat, but the stock slid in after hours. The market is digesting the guidance, and we have broader turmoil. The S&P is down.
Right.
But looking at the chart, Netflix is trading significantly below its highs. We are talking roughly 40% off the peak.
Which, for a company with these fundamentals, is a massive drawdown. It's technically in bear market territory relative to its own recent history.
And the valuation models are all over the place. I was looking at some of the data, and there is extreme divergence.
Wildly different.
You have some conservative models seeing upside to maybe $132, but then you have these bullish analyst price targets ranging as high as $13.60.
That spread is wild. It's almost unheard of for a large cap stock.
It is. It highlights just how volatile this is and how different people are valuing the future growth.
Well, some see a mature streamer. Others see a tech and advertising giant in the early innings.
Exactly. So looking at the indicators right now, is this a falling knife or is it finding a floor?
Well, if you look at the RSI, the Relative Strength Index, it is hovering around 29.
Okay, for those listening who don't stare at charts all day, what does a 29 tell us?
Anything under 30 typically means oversold.
Right.
It implies the selling pressure has been exhausted. Think of a rubber band stretched too far down. It suggests the stock is due to snap back.
A signal that the bears might be running out of steam.
That's the idea.
Okay, so it's oversold. Are there other signals?
Yes. The MANZ-D, which tracks momentum, has shown a bullish crossover. That is when the short-term momentum line crosses above the long-term line. It's often a precursor to a rally.
So the technicals are flashing a potential reversal. What about the smart money, the institutions?
Looking at the options market, there is a surge in call options for January 2026 expiration.
That's the big money betting on a move up.
Exactly. Institutional money seems to be positioning for a breakout. They are likely betting that once the dust settles on this Warner Bros. Deal, the focus will return to that ad revenue ramp.
And the volume supports that? Or is this just retail traders gambling?
Volume is elevated around earnings, which is normal. But the fact that the dip is being bought suggests long-term bulls are stepping in. They see this 40% discount as an opportunity.
Not a warning sign.
Exactly.
Okay, so the chart is saying oversold. Let's shift gears to what the people are saying. Pivot to sentiment and the news flow. What is the vibe out there?
If we look at the quantitative scoring, specifically from Alpha Vantage data, the weighted sentiment is officially bullish.
Okay, so the algorithms like the news flow.
They do. You have major outlets like CNBC being bullish,
Yeah.
specifically citing that 325 million subscriber count.
And the Golden Globe's Success 7 wins.
Yes. That matters more than people think.
It signals to talent that Netflix is still the place to be if you want to win awards.
Precisely. It validates the content dominance thesis, and the analysts are backing it up. HSBC initiated a buy rating. Wedbush is maintaining an outperform.
So the pros are telling their clients to buy.
They are looking at this pullback and saying, go.
But, and there's always a but, we have to talk about the rumor mill. Because there is one massive story dominating everything.
The acquisition.
The potential $82.7 to $83 billion all-cash acquisition of Warner Bros. Discovery.
It is the elephant in the room.
It's a whale in the room.
But
83 billion all cash. I mean, I'm a skeptic here. On one hand, you get HBO Max, you get Harry Potter, you get DC. It's an IP goldmine.
it is arguably the best library of content in the world outside of Disney.
Yeah.
Maybe even better for adult audiences.
But the debt, the integration, we've seen these mega mergers go wrong so many times. Remember AOL, Time Warner?
Classic disaster.
Why would Netflix, which is printing cash, want to risk this?
It is a valid fear. But if you look at the strategy, it aligns with what Ted Sarandis has been saying. He's committed to a 45-day theatrical window.
Right. They want to play the blockbuster game properly.
And think about the synergies. You plug HBO content into the Netflix recommendation engine. That is powerful.
It is. It effectively ends the streaming wars if they pull it off. And there are other catalysts too, right?
So it's not just the merger. Cloud gaming is generating a lot of buzz. They are running simulations for FIFA.
Wait, FIFA, like the soccer game?
Yes. Imagine playing a high-fidelity FIFA simulation directly through your Netflix app. No console required.
Yeah.
That is the stickiness they are chasing.
And the interactive ads you mentioned?
Right. So the sentiment isn't just, hey, they bought a movie studio. It's they are building a comprehensive entertainment ecosystem.
And what about the big money? Are they buying this narrative?
We aren't seeing massive insider buying clusters. No huge Form 4s where the CEO is buying millions of shares personally. But as we noted in the technicals, the options market signals institutional accumulation on the long side. The funds are buying the upside calls.
Okay, so the bulls are betting on the ecosystem. But my job is to be the buzzkill. Let's look at what could go wrong. Let's do the bear case.
Let's do it. There are real risks here.
I keep coming back to this debt trap. $83 billion?
Yeah.
Even for Netflix, that is a staggering amount of money.
It is. If interest rates tick up, that debt becomes very expensive.
And it creates massive integration risk. You're merging two giant cultures. The estimates are showing a potential 0.5% drag on margins just from M&A friction.
That's a real risk. Efficiency usually dips before it improves in these situations. It could be messy for a year or two.
And it's not a done deal, right? There are legal hurdles. I saw some somewhat bearish news about a potential Paramount lawsuit or a proxy fight.
Yes, the media landscape is a shark tank. Paramount or others could try to block or complicate the deal, creating uncertainty.
Yeah.
Markets hate uncertainty.
And beyond the deal, let's look at the core business. Growth deceleration.
Go on.
The password crackdown, that was a huge tailwind for the last 2 years. Everyone who was mooching finally got their own account. But that is a one-time trick. That tailwind is fading.
That's true. You can only crack down once. They have squeezed that lemon dry.
And the US-Canada market you can is maturing. The forecast is for an 8.5% CAGR. That's not hypergrowth anymore. Can they really keep raising prices without people canceling? Churn is a real thing.
It is the classic saturation problem. Where do you find the next 100 million subscribers?
And finally, guidance risk. The fact that the stock slid post-earnings tells me the market is hypersensitive. They beat earnings and the stock still dropped.
Because they're worried about the future.
Yeah. If they miss even slightly on guidance next quarter, this stock could get punished.
I agree with all of those points. They are valid. The path is not clear of obstacles. However,
Here comes a rebuttal.
I would argue that the risks are priced in. When a stock is trading 40% off its highs, the market is already assuming some bad news.
That's fair. You're buying it with the fear discount attached.
And you have to look at the safety net. Ad revenue doubling to $3 billion. That's pure high-margin revenue. And margin expansion to 31.5%.
That gives them a cushion.
A lot of cushion to absorb the M&A risks. Even if the Warner deal is messy for a year, the core Netflix engine is printing enough money to handle it.
So you view the ad business as the insurance policy against the M&A risk.
I do. And more than that, it's the bridge to the next level of valuation.
Okay. We've looked at the numbers, the charts, the rumors, and the risks. Let's wrap this up with a score. What is the verdict?
When I look at the whole picture, I see a company that is evolving. Netflix is no longer just a streaming service where you binge a show and cancel.
It's more?
It is becoming an ad tech giant and a gaming platform.
So what's the number?
I am giving this a bullish score of 8/10.
An 8 out of 10, that is confident, especially given the recent drop.
It is. Here is the elevator pitch. You are getting a company growing revenue at 18% with margins expanding to over 31%. But you are getting it at a significant discount, trading 40% off its highs.
It's the growth at a reasonable price argument.
Exactly. The ad tier explosion doubling to $3 billion is real. And if the Warner Bros. Deal closes, The IP synergies create asymmetric upside.
So you're buying the volatility.
You're buying the volatility now for a payoff that could play out over the next few years.
So this isn't a flip it next week trade.
No. The target horizon here is a multi-year hold. You want to hold this into the Warner deal close, which is estimated for Q3 2026, and let that ad ramp fully monetize.
Don't gamble on the noise.
Don't gamble on the noise.
Okay, so the verdict is, the scary headline numbers regarding debt and stock slides are masking a fundamentally stronger engine underneath.
Precisely. The market is looking at the past quarter's slide. Investors should be looking at the 2026 ad revenue.
Well, there you have it. An 810 for the streaming giant that keeps reinventing itself. It's going to be a fascinating year to watch if they can digest that Warner Bros. Meal without getting indigestion.
It certainly will be.
That's all for today. Make sure you subscribe to the channel so you don't miss our next analysis. We've got some interesting ones coming up. Thanks for listening, and we'll catch you next time. Welcome back to Invest